Yesterday, the president of France Emmanuel Macron announced that the country will have to go through another lockdown. This lockdown will be a bit lighter than the previous one, but it is still expected to deal a significant blow to oil demand in France. Currently, the markets wonder whether other European countries will follow suit. For example, the situation is very challenging in UK, but its government is trying to avoid a full lockdown. At this point, the situation in Europe is the main problem for the oil market, although the recent developments in the US are also worrying. Yesterday, the US reported more than 81,000 new coronavirus cases. While nobody expects that any serious anti-virus measures would be introduced before the US election on November 3, 2020, the US may be ultimately forced to impose additional curbs in case the number of new cases continues to increase. As the US is the world's biggest economy and the main oil consumer, such scenario will be bearish for oil. Yesterday, Saudi Aramco stated that current oil demand was not robust enough to justify boosting oil production. Currently, OPEC Plus countries are set to increase their oil production by 2 million barrels per day at the beginning of 2021. However, it is already clear that OPEC Plus will be forced to keep current production cuts intact for the first months of 2021 as the world failed to contain the virus and has to deal with a powerful second wave of the disease. In this situation, demand for oil will be under pressure at a time when Libya plans to increase its oil production from 500,000 to 1 million barrels by the end of 2020. Libya is exempt from the production cut deal due to the civil war in the country, so OPEC Plus cannot stop Libya from getting back to its normal production levels. In addition, inventories have started to increase, which is a signal that demand has already stalled. Thus, the only option for OPEC Plus is to continue with current production cuts for the first quarter of 2021. In the near term, the coordinated action of OPEC Plus countries is the main hope for oil bulls. The West Texas Intermediate crude oil market has broken down during the trading session on Thursday, slicing through the crucial $36.25 level that had been so supportive. However, we have broken down through there and reached towards the $35 level. We have bounced from there, and now it looks very likely that we will continue to short off signs of exhaustion. Looking at this chart, the market will probably continue to drop from here and perhaps reach much lower. Ultimately, I like the idea of shorting this market on rallies as we have further to go to the downside from a serious lack of demand and of course Europe locking itself down.